bringing to a close an extraordinary day on Wall Street. Hi, everybody. Welcome to the Closing Bell. I'm Maria Bartiromo. Today in London, the rescue of Bear Stearns dominating the entire trading day on Wall Street, leading the market lower right from the get-go. Tonight, the Dow Jones Industrial Average finishes the week and the day with a decline on the session of 191 points. Another ugly day for stocks. S&P 500 today giving up 27 points, more than 2%, and the Nasdaq Composite losing 2.25%, a decline of 51 points. Bear Stearns today leading the tumble on Wall Street. The stock plunging 45% after the New York Federal Reserve and jp+morgan agreed to provide an emergency financing to the Wall Street firm. Take a look at the stock trading. It was fast and furious. It finishes today at $29.75. That is a whopping loss of $3.5 billion in market value today alone. The number is even more dramatic when you're looking at the company over a 3-month period. There it is, down $8.9 billion, roughly 68%. The market cap loss, nearly $9 billion in a 3-month period. A startling sum even for a company that marked the start of it all with the failings of 2 hedge funds last summer. Today's announcement from Bear Stearns and the New York Fed coming as a shock to Wall Street, because just 2 days ago, the CEO of Bear, Alan+schwartz, was on CNBC in an exclusive to dismiss rumors of a cash crunch. He told CNBC investors and the Wall Street analysts the firm liquidity position was fine.
The markets have certainly gotten worse, but our liquidity position has not changed at all. Our balance sheet has not weakened at all.
And yet, 48 hours later, everything changes. This morning, Schwartz said that the firm's cash position had deteriorated sharply over the past day. Questions now being asked at this hour. What did Schwartz know? When did he know it? Is he simply not aware of the extent of the problems at the company he heads? Or do things change that quickly that a company needs to orchestrate a rescue within a 24-hour period in these volatile and uncertain days? Under today's agreement, the New York Fed and jp+morgan Chase have agreed to provide an unspecified amount of secured funding to Bear Stearns for up to 28 days. The Fed will provide non-recourse back-to-back financing to jp+morgan Chase. jp+morgan says it's working closely with Bear on securing permanent financing or other alternatives for the company. We continue following this story throughout the next hour here on Closing Bell. But first, let's get the trading action for the rest of the market. Bob Pisani, our eye of the floor of the New York Stock Exchange, in the thick of everything. Bob.
And we had an inflation report this morning that seemed like a million years ago. It was better than expected. We had a rally for 3 or 4 minutes, and of course the Bear Stearns story dominated. Let's take a look at the markets at the close, folks. 30th time this year we have had a triple-digit move in the Dow Jones Industrial Average. Is that remarkable or not? You know what happened with Bear Stearns? The rumor became the reality. So all the rumors got way too ahead of even the people's ability to manage it, and that's really the story. By the way, there's other things going on here today, and I want to tell you about them. Airlines and drugs were particularly ugly on the day. Let me just show you the financials here, because remember, when rumors get away, who knows where else it can go? That's the worry here. Lehman, Merrill, Citigroup, all down here. Of course, we're talking about new lows in Lehman and Merrill here. 6% move to the downside on Citigroup. Drugs are at new lows again here. Now, we had some disappointing news relating to Amgen as well today, but Bristol Myers, Eli Lilly, Merck, Pfizer, all hit new lows again here today. So there are other sectors that are also experiencing some pain completely independent of the Bear Stearns issues. Would it be a day if I didn't have another big drop in airlines? Are you tired of hearing me talk about airlines? 5 days this week, we've seen 6, 7, 8, 9, 10% moves, declines in airlines. It happened again late in the day as all the airlines moved down. These are multi-year lows for the airlines. What was the good news? Is there any good news here today? Well, at least the fear factors are jumping up here. Of course, the VIX measuring the cost of buying put and call options on the S&P 500 spiked to the highest levels since January. Maybe not an obvious bottom, but at least some signs that the fear is moving in here. Next week going to be a very big, important week. The Fed meeting, quadruple witching, Goldman, Lehman, Bear is going to be reporting on Monday. They moved that up. Speaking of moving up, they're moving up the IPO for Visa to Wednesday. It was supposed to be trading on Thursday. It moved up by 1 day. For the week, the Dow Jones Industrial Average up fractionally. Mixed picture here. S&P and NASDAQ just fractionally to the downside. Maria, back to you.
All right, Bob, thanks very much. Let's get a closer look now at the Bear Stearns fallout and the stock market sell-off today and the credit market tightness. I'm joined now by Scott Black, president of Delphi Management, along with Andy Harding, chief investment officer for fixed income in Allegiant Asset Management. Gentlemen, nice to have you on the program. Welcome to Closing Bell.
Thank you, Maria.
Scott, let me kick it off with you. How are you investing in this environment?
Well, we normally have to stay fully invested, but since the credit crunch came in August, we've been net liquidators of financial securities. We haven't bought anything at the margin, and we're going into businesses that have high returns on equity with sustainable earning power. We have heavily weighted in things like energy and metals. We've been bottom fishing in technology and in the manufacturing sector where the companies have big exposure into Asia as opposed to just being domestic providers.
Andrew, let me ask you about the fallout in Bear Stearns. How is the news here affecting the credit markets?
Well, initially it was pretty bad for the credit markets, and we saw another flight to quality in treasuries. But given the news and given the response by the equity markets, I actually think the credit markets held in fairly well. Mortgage-backed securities almost kept pace with treasuries today, which, given how they've been trading over the last couple of weeks, we were quite pleased with. And credit-related securities outside of the financials hung in there pretty well relative to treasuries. Not real well, but pretty well given the circumstances.
So how do you invest then in this environment? You know, it was almost like a head fake earlier in the week when the Fed comes out with that $200 billion plus in new injections for opening windows for the banks to borrow easier, and we had that big rally, and then no follow-through.
Well, that's the thing that's giving the markets a hard time. Every time the Fed does something, it doesn't seem like it's enough. This is a long process. What we have been doing over the last couple of months is scaling in riskier assets because the risk premiums at this point in the bond market are very attractive, and a 1.4% two-year note just doesn't excite us at this point. So we're scaling in things like agency mortgage-backed securities, some credit-related securities, because we feel over the long run you're going to get a better return on those than you will off of U.S. Treasuries. And this is a reversal from where we were last year. But it will turn around. I don't know when exactly. It's a long process, but it will happen because the Fed and the Treasury are taking every action and will take more action if they have to stimulate this economy and to revive the housing market.
And of course, we continue to see bad news on those fronts. Scott, you're a value guy. You have been known to find value and opportunities when actually things are at their worst. Tell me your feeling right now about financials. Do you think we've seen the bottom? Is there more pain to come, or are you actually finding some value here?
No, I'm avoiding the financials, Maria. You know, people can say ostensibly there are low PEs, but we don't really know what the E is. There was a G7 meeting not that long ago in Japan, and some of the foreign ministers estimated there's another $200 or $300 billion to be marked to market. We've seen about $140 billion of a drop so far, but every day, whether it's on your program or in the newsprint, there's another revelation. $2.5 billion here, $7 billion here, whether it's United Bank of Switzerland or Landesbank in Germany. We have a lot of wallpaper around the world that we distributed, and there's more mark to mark, and I'd be extremely cautious about buying financial